You are live.
Hello and welcome to another 30-Minute Thursday. My name is Amit. It is 2 p.m. Pacific time in the glorious, very wintry Pacific Northwest. We are live on Facebook. I hope you guys are doing great. Hope you're staying safe. Hope you're staying healthy. Hope you're staying sane, of course. Watch out for the flu this year. I hear it's really bad. Watch out for the other stuff that's floating around and flying around. Stay healthy, stay safe, stay sane, and get ready for a wonderful holiday season that is upon us. I can't believe it. It's like 10 days until Christmas. Who would have thought? This year is just almost gone. But we still have a little bit more before it's all over. So thank you guys for joining me a little bit on Facebook today. Let's talk about what's going on in the economy, what's going on in the markets, what's going on with the Federal Reserve Board. They did meet. The FOMC, the Federal Open Market Committee, met on Tuesday and on Wednesday. So yesterday, they made their decision to raise interest rates, short-term interest rates, by another 0.5%. So now the federal funds short-term interest rates somewhere between 4.25 and 4.5%. And that is the last meeting of the year for 2022, so we can close the books on that. Yay, it's about time. And it was expected. It was an expected meeting. It was an expected rate hike, short-term rates, not mortgage rates. I keep trying to reiterate that, but I know it's very, very confusing. The mortgage rates actually are appreciating the fact that the Fed is raising their short-term rates. And so mortgage interest rates are coming down, even though the federal funds rate is going up. And that is really counterintuitive. So I just want to explain that to you guys, talk a little bit more about that, and also talk a little bit more about what to expect in 2023, right? I mean, we have, at this time of year, people tend to do a lot of things where they take stock in what they achieved for the year. They start to think about, what did I do well? What should I do better? What are my goals for 23 and for the year coming up? And I want to talk about that as well. I also want to talk about, in general, what's going on with the economy, what's going on with inflation. What did the Fed Chairman Jerome Powell say yesterday? How did the markets react to that? There's a lot going on. So we're going to just jump right in, and we're going to talk all about that. As always, my colleague Dana is working behind the scenes and behind the screen over there, and she's actually changing cameras. So check it out. Boom. I could look at this camera and I got a different angle. I could look at this camera and I've got a different angle over there. Dana's pretty quick, and I've got a face still made for radio. So the whole thing freaks me out, but I'm just letting you know that the fabulous studios here at New American Funding, fully equipped to take on even the most kooky of radio faces and put us on video and try to make us look good. So let's talk about the Fed. Let's just jump in here, all kidding aside. So what happened this past week was really, really big. On Tuesday, the Consumer Price Index came out for the month of November. Consumer Price Index, also known as CPI, is a measure of inflation. It's not the favored metric that the Fed really, really likes, but it's a very important metric. And as expected, the rate of inflation in November, so that's this past month, came down. And when you add up this last month, November, plus the 11 months before that, leading up to that, the annual year-over-year rate of inflation is showing a downward trajectory. That's really good news. This is what the Fed is trying to achieve by raising all these interest rates. And they have. They've raised interest rates every time they've met. Every 6 weeks since March of this year, they've raised interest rates by some percentage at some point. So they continue to do that, but it's working. And we see that in the Consumer Price Index as well as the other measures of inflation. So despite the fact that the Consumer Price Index, the CPI, came out on Tuesday and it showed a favorable number, look, the year-over-year number, headline number, was like 7.1%. That's nothing to take a victory lap over, right? The Fed wants to keep these inflation rates at 2% year over year. To say we're at 7%, don't pat yourself on the back too hard and break your arm, as they say. You still got a long way to go, but it's going in the right direction. And we have to see that as progress. And so the markets, the bond market, looked at that very favorably. And the environment that generates mortgage interest rates within the bond market is looking at this in a very favorable way. And so interest rates are starting to trend downward on mortgages. That's awesome. So the Fed, on the heels of the CPI, the Consumer Price Index on Tuesday, the Fed had their meeting, which was scheduled for the 13th and the 14th. Now the Fed meets for 2 days, and on the second day, they make their decision about what they're doing with the interest rates, and they also make their decision about where they make comments to the media about their decision. The comments are what really can move the markets. The interest rate hikes or lack thereof, it's kind of baked into the cake, guys. So they're not going to really change what happens. It's already kind of telegraphed. But what they say about these changes, what they say about these moves, that can really move the markets one way or the other. And what Jerome Powell, the chairman of the Federal Reserve Board, said yesterday suggests that they're going to take a more moderate approach into 2023. And they're going to take a wait and see attitude as far as what they're going to do with future rate hikes. And they're thinking that they're not going to be increasing interest rates by as much whenever they do increase rates. So all of that is looked at very, very favorably by certain parts of the market. And I'll say certain parts because the stock market today, the Dow Jones Industrial Average, for example, is down more than 700 points. The S&P 500 is down almost 100 points. Some parts of this market do not like what the Fed is doing, but the mortgage interest rates love it. And that's what I'm here about. So you got a double-edged sword here. On the one hand, mortgage interest rates, they like that. They feel it's a favorable sort of move. On the other hand, the stock market, which is where your 401k and my 401k and a lot of people's stock options from their companies, whether it's Google or Amazon, Microsoft, they don't necessarily like it. So it's a give and a take. But Jerome Powell said yesterday, we're going to take a more wait and see approach. We're going to moderate the depth or the amount by which we're going to increase rates in the future. And we see the terminal rate somewhere between, where we are right now to maybe 5 or 5.5%. Terminal rate means like this is the highest we're going to raise it to, somewhere between 5 and 5.5 or maybe 5.25%. Keep in mind, we're at 4.5 or 4.25 right now. So they're saying that, hey, there's still somewhere between 0.5% to a full percentage point that they may raise their rates in the coming months into next year. So they're not saying that we're done, but they are saying that we're not going to be raising rates like we did a couple months ago by 75 basis points, 0.75% in one clip. So they are taking a more wait and see approach. And that's a really big deal because it signals to the markets and it signals to the home buyers and the consumer in general that we're pushing through the tough part of this economic slowdown, the tough part of this inflationary pressure, and hopefully we're on the sunny side of that. But there's still a lot more to go. And I don't want to be too rosy at the risk of being considered a Grinch. I'm not a bah humbug kind of guy, but look, we're in the Christmas shopping season right now. And my wife, God love her, she's stimulating the economy. I just took her to the mall yesterday. I walked through the mall and saw there's a lot of people there. There's a lot of people shopping at Bellevue Square here in the Pacific Northwest. But I don't know what ultimately is going to happen with retail sales. One of the reasons why the stock market is down as much as it is today is because retail sales for the month of November came out just recently. I believe it was today. And those retail sales are weaker than expected. And that signifies that, people are pulling back a little bit on their expenditures. They're thinking a little bit more about what are we doing here with regard to our budget? What are we doing here with regard to our savings? What are we doing here with regard to our credit card balances? And that's a big deal because when the Fed raises their short-term rates like they just did yesterday by another 0.5%, that gets translated directly to the costs of your credit card balances on your interest payments. So when people carry balances on their credit cards, which most people do, when the Fed continues to raise interest rates, their interest rates and their cost for carrying that balance continues to go up. And so you see people now, or at the very least, the data from last month suggests that people are starting to make some choices. People are starting to reduce their expenditures. People are looking at things a little bit more cautiously. And going into December, that's a really big deal. As you guys well know, we call December the Black Month, not for any reason other than that's when a lot of retailers actually make their profits for the year. Up until December, they're treading water, they're keeping things pretty even keel, but a lot of their profitability comes at the very end of the year when people go out and start spending for Christmas. And that may or may not happen in great amount this year. We will find out in January how we did in December. And so that's going to be a very telling sign of what comes next. So we're not out of the woods just yet, not by a long shot, but we are moving in the right direction. And because we're moving in the right direction, because the rate of inflation is coming down, because the Federal Reserve Board is signaling to the markets and telling the markets, it's not a signal, they're not sending coded messages, they're speaking to the cameras just like I am. Of course, they've got a lot more cameras and there's a lot more interest in what they have to say, but they're saying it straight up. Hey, things are getting better. We're going to take a more moderate tone. And in the interest rate environment for mortgage bonds, what that suggests is as inflation comes down, the spending power that we have, or the buying power that we have from these fixed rate investments, which is what mortgages are, that buying power starts to tick back up again. As things cost less money, the money that I make on my investments in a mortgage starts to be able to buy more goods and services. The more goods and services I can buy, the less interest I need to charge on future investments. And that's what's bringing the rate of the 30-year fixed rate mortgage, for example, it's starting to come down. And that's awesome. We like to see that. We want to see more of that. How far will it go? I don't know. But I feel, and the people that I subscribe to, the market forecasters and the services I subscribe to, are suggesting that in the next 6 months, so sometime between now and call it May, call it June of 2023, we may see mortgage interest rates in the mid 5% range, maybe even lower. That would be awesome. Just in time for the summer shopping season. That would be fantastic to see mortgage interest rates come down by another 1%, 1.25%, 1.5% on the 30-year fixed. I think a lot of buyers are going to take note of that and they're going to jump back into the market because there's still a lot of demand. That hasn't changed. That has not subsided. What has subsided is people's urgency in making offers, because right now people are nervous, and I get that. Interest rates went up by quite a lot. All of a sudden, people's buying power kind of diminished. Then on top of that, you've got these corrections in the stock market. If you're sitting on a bunch of stock from Amazon or Microsoft or any number of other places, and you feel that your portfolio value is coming down, you may not be as inclined to sell those stocks to generate the cash necessary for a down payment right now. Totally get that. And that is part of the overall economic calculation that home buyers and investors and consumers need to make in general. So there's still some stuff to work through. There's still some challenges, but in general, things are moving in the right direction. We take a look here. All right. So speaking of moving in the right direction, we're only 15 minutes into this conversation, and I'm really happy that we can talk about some of the other things that are going on in the markets right now, because necessity is the mother of invention. And because we need to bring the buyers back into this market right now, there are a lot of really great deals to be had. If you're truly a buyer, if you're truly wanting to purchase a home right now, today is probably the best time, especially if you want to buy new construction. The reason I say that is because new construction builders are going to do all sorts of seller specials and price reductions or credits or what's the word I'm looking for here? Upgrades, that's the word I'm looking for. Upgrades to the cabinets, upgrades to the flooring, upgrades to the appliances, whatever it is, to get people off the fence and into a contract to purchase. And so this is, if you really want to be a buyer, this is a really great time to do that. Even if you're not looking to buy new construction, this is a great time to do that, because anyone who's listed their home for sale in the holiday season honestly and truly wants to sell their home, right? They're not just throwing it out on the market to see what the consumer is willing to pay for it. And if we don't get our price, we're just going to pull it back and we're going to live there for the next several months or several years. They really want to sell their house. As a personal story, the homes that I've bought in the Seattle market, and I've bought 2 homes over, since 2003. I purchased my first home in the Seattle market in 2003, and we closed it in December. So our sellers, they were the original owners of that home. It was a 1976 home, and they bought it brand new from the builder. And we bought it from them in the holiday season, in the wintertime. And we were motivated to buy. They were motivated to sell. Now, granted, 2003 was a completely different market. And some of the people that are watching me on Facebook, probably not on Facebook, but if I was on TikTok, some of the people that are watching probably weren't born in 2003. And that's just the way it is. So I don't know how that makes you guys feel, but my knees just started aching just thinking about it. In any event, we bought that home in 2003, and we were motivated buyers, and our sellers were motivated sellers. And so we were able to do some really good negotiating at that time. And then coming into the home that I currently live in, we bought that home. Now, it wasn't, we found it in August of 2016. So it wasn't exactly the holiday season, but we closed on it in the holiday season. We closed on it in November. So right before Thanksgiving. And interestingly enough, that purchase was a contingent purchase, contingent on the sale of the home that we had bought in 2003. And I wish I could have kept that 2003 home. I'm not going to kid you. It would have made a great investment, and I would have done really, really well with it. But unfortunately, I couldn't afford it. I could not afford to keep both of those homes and to qualify for the financing. So I had to make a tough choice, and we sold the old home so we could buy the new home. And guess what? We were in a contingent offer on that, meaning that when we found the new home, we asked the seller, and it was new construction, new home. We asked the seller, hey, will you sell us this home on the contingency that we sell our current home and use that money for the down payment? Will you get into a contract with us to do this? And that seller said, yes, I'll do that. And so once we signed the purchase contract to buy the new home, we had 5 days to get our old home ready for the market. A lot of people right now are talking about doing contingent offers, or doing certain deals like, hey, I want to buy the new home, but I got to sell the old home first. And there's a lot of talk about doing contingent offers right now because the market's slower. Sellers are willing to consider that, and buyers are thinking that, hey, this is great for me because I only have to move one time. I don't have to go crazy and pack up all my stuff and move it out into a short-term rental or into storage and then move into the new house. And people think that doing a contingent offer is a simple solution. Having gone through it myself, I got to tell you, it's not easy at all. Contingent offers are really, really complicated. What happens is, first of all, you got to pack all your stuff. You got 5 days to get your departing residence, your current home, ready for the market. That means deferred maintenance. That means cleaning the carpets. That means painting the walls. That means pulling stuff, furniture out of the house and into the garage or into storage or into someplace else so your real estate broker can stage the home properly. You've got all sorts of other things that need to happen. And guess what? You're living in the home while people come to show the property, or while people are doing open houses in your property. So when that's going on, you have to leave. I mean, you can stay if you want, but that does not enhance the sale of the home. So I spent a lot of time down the road at the neighborhood pub. I spent a lot of time at friends' houses and whatnot. And then when you're not leaving the house for a showing or an open house, you got to live in that home like it is a museum, because you want to keep it clean. You have no idea when somebody else is going to show up to see the home or to consider writing an offer. So you got to keep it pristine. You can't even live in your own home. I swept more leaves in the month that we were on the market than I did in the decade that we lived in that home. But that's just the way it is when you do a contingent offer. The reason I bring this up is because I've been talking, we check my time, yep, we're still good. The reason I bring this up is because last week I spoke with you guys about the Buyer Accepted program, and I continue to speak about this program because it is a really wonderful solution to the contingent offer. And I want to make this available to my clients. I want to make this available to my referral partners. I want to make this available to real estate brokers who are not yet my referral partners. Because what the Buyer Accepted program allows us to do is, for the clients who qualify, we will, through our affiliate company, we will buy your new home on your behalf for cash. You move into that home. You rent it back from us on a prearranged schedule, so we know exactly what the rent's going to cost. You don't pay that rent until the very end after you sell your current home, but you move into that home. You live in that home, you unpack, you decorate, you drag all your furniture over, you do all the things that you need to do in order to move in and get settled in and live your life. But in your old house, the one that you have to sell, now you're not living there, which means that your real estate broker can actually do the deferred maintenance or the staging or the cleaning or the painting or the whatever it is necessary to get your house really ready for the market. At the same time, you do not have to worry about what it looks like when you're living there and you're, I gotta make the bed all the time. I gotta rake the leaves up all the time. I gotta keep the kitchen spotless all the time, which means I can't eat in my house. I gotta do all these things, or I have to leave the home when someone calls to make an appointment to show the property, or when my real estate broker wants to do an open house. All of these things create a real mess for the homeowner. And we think, oh man, doing a contingent offer, I get to sell my current home before I close and buy my new home. That's going to solve all my problems. It may solve some problems, but logistically speaking, I will tell you that it is really complicated to do this. And you may think that you're getting yourself into a good deal and then find out that you've bitten off a lot more than you care to chew. And so as we're talking about the Christmas holidays, as we're talking about the markets perking back up coming into the new year, interest rates are going to continue to come down, which means that buyers are going to come back into this market. And when that happens, guess what? Sellers may be less than eager to do contingent offers or to do these other sorts of things, because the more demand there is and the supply is the same or less, guess what? Things change, and now it reverts back to a seller's market. Right now, we're kind of in this buyer market of sorts, but as soon as more of the buyers come back into the market, we're going to see the sellers start to change their tune. They may not be as keen on doing contingent offers. They may not be as keen on giving credits to the buyer for closing costs and prepaid expenses and things like that. So this is an opportunity. It's a very unique time of year. It's the most wonderful time of the year, as the song goes, but it's also a really unique time in the market and in the season when real home buying can happen, because buyers are motivated and sellers are motivated. You check my time here. We've got about 5 more minutes. So I just want to close it out with that. And I want to invite you guys to really call me about the Buyer Accepted program. My phone number is right behind me over here. My email is right behind me over here. I would love to speak with you about this, because it changes the entire complexion of a real estate transaction. Even if you don't have a home to sell, when this market changes, and it will, and when the sellers get the upper hand again, and they will, because there's far more buyers than there are sellers, even when that changes, this program is a very cool way to compete, because in essence, as a buyer, you are coming to the seller as a cash offer, full cash, pure cash money, no mortgage from that transaction. And there's a few moving parts as to how that works. There's a few things that we would need to do in advance to get you guys qualified as buyers to work within this program, and as as real estate brokers to be eligible to serve your clients. You have to do a little training with us. So I urge you guys to take a look at this number here behind me. You can text me on that number, you can call me on that number, you can email me at this email address, and let's talk about this buyer accepted program. I'm going to keep talking about it. I'm going to keep just hammering away at it because it's so unique and people need to hear about it in order to really internalize what it can do for them and their clients. So with that said, I'm going to cut a little bit short. We've got a few minutes left, but we don't have to use up the entire 30 minutes. I'll bank it for next year, and we'll talk about other stuff coming into the new year. In the meantime, I want to first and foremost thank you guys for spending a little bit of time with me on this Thursday afternoon. We have one more next week, one more for the year. Actually, we probably have two more for the year, but we have one more before Christmas, and I'm looking forward to seeing you guys again at 2 p.m. Pacific time on Thursday afternoon. In the meantime, I hope you have a fantastic day. If you are in the Pacific Northwest, get out and get into some of that beautiful sunshine. It is not warm, but it is sunny and beautiful, crisp. You guys not in the Pacific Northwest, I feel for you because we do have a real winter and it's very seasonal and it's very holiday spirit. But for everybody, I wish you a wonderful day, a fantastic weekend coming up. I hope you stay safe. I hope you stay healthy. I hope you stay sane. And I hope to see you again next week, right here, 2 p.m. Pacific time on Thursday. Thank you so much. Take care.